We're half an hour away from the opens in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Annabelle Drawlers with David Ingles.
Good morning. Let's get to your top stories today. Stocks across the Asia-Pacific on the up after tech drives Wall Street to yet another fresh record high. The euro and French bonds are under pressure with the government on the verge of a collapse.
Asian chip stocks are gaining as fresh US curbs on Chinese access stop short of earlier proposals that would have sanctioned more key firms.
And China's progress toward net zero back in focus as the Bloomberg NEF Summit, or NEF Summit, gets underway in Shanghai. We speak to key players in the clean energy space.
All right, taking a quick look at the market action this morning. Actually, there's quite a bit of positivity coming through. You've got the broader gauge trending up 0.8%. We did have a pretty good session on Wall Street overnight. I can get into the details in just a moment. Futures here looking fairly flat. But what else is helping the complex is that pullback. We saw the dollar snapping 3 days of gains. Of course, something else that's supportive for Asian equities. Still quite a few unknowns. We've got Fed speakers, of course, coming up. Jay Powell, he's really going to set that direction around the health of the labour market, what that means for the outcomes for rates. And then adding to that as well, key economic data on the horizon, and that is the payrolls figures that are due late Friday as well. Where we are seeing most of the gains coming through so far is really in those tech-heavy indexes. You've got Taiwan just coming online, 1.7% in the green, Kospi 1.2%, Nikkei as well, some tech exposure up 1.3% so far. But it is after we had the US imposing some fresh restrictions on China's access to advanced chip making and computing technology. Let's take a look at how those chip makers are faring so far. SK Hynix, of course, heavily exposed in this space. If you take a look at some of the movers, you've also got Samsung. These are really in that HBM, high bandwidth memory play. Tokyo Electron, equipment maker. TSMC, of course, we know that major fabricator. Still, the rules from the US haven't gone perhaps quite as far as they could have. And so we are seeing a little bit of relief coming through. Tokyo Electron, 4% so far to the upside. But let's change on. Taking a look at how that's setting us up for Chinese equities today. Again, we're looking mostly to some gains here. Futures have just kind of been peeling back a little bit, trending fairly steady right now. PMI readings, of course, yesterday, a bit of optimism coming through, but it could also be a story of front-loading for the exporting names. So a few more details to drill into. But let's also take a look at what is the big story in the session so far. That is the French government, of course. We know really on the verge of collapse at this point in time. Dave's going to get through the details, but what I do want to point out is that French bond yield premium over Germany's, this is looking at the 10-year yield, that spread is now at its highest point, going all the way back to 2012, Dave.
Yeah, and we know what happened back in 2011, 2012. I should also mention that when you look at that chart, there's another chart also that's going around. We'll show you about later on. Credit default swaps, I think, are back at 41 bips, highest since, I think, when Rona first hit us about 4 years ago on French debt. Now, speaking of in more details on this, so as Bell was pointing out, the government in France appears close to collapse, with far-right leader Marine Le Pen pledging to join this left-wing coalition to topple Prime Minister Michel Barnier's administration. It comes after, of course, they invoked this constitutional mechanism to adopt a social security bill without a vote. That's the operative word there. Le Pen has the largest party in the lower house of parliament.
This bill is now here. Now is the time to act to implement it. I believe we've now reached a moment of truth which confronts everyone with their responsibilities. It's now up to you, members of the Parliament of the nation, to decide whether our country adopts responsible financial texts, essential and useful to our fellow citizens.
All right, let's get more on this story in the market reaction. Bring in Ian Steely. He's International Fixed Income CIO at JP Morgan Asset Management. And Ian, with the market pricing that we're seeing, is this something that you see as an opportunity or just something French debt, stay away from it right now?
I think at the moment you've got to be probably standing on the sidelines, because ultimately what we're seeing is unprecedented. I think you just mentioned it. It looks like we're going to have a collapse of the government tomorrow. You know, it causing questions about what budget is likely to be able to occur next year. Yes, the spreads are very wide at the moment and they're hitting levels that we saw back in the peripheral Eurozone crisis. But actually, when I look at just European debt in general, I think there's just some much better stories out there. Much more comfortable owning Spanish debt, much more comfortable owning Italian debt, something we wouldn't have considered saying a few years ago. So I think for the moment, sit on the sidelines and take your opportunities elsewhere.
Right. I think even Greece has lowering borrowing costs right now than France. To your point on European periphery, I want to ask you about the Fed. I think Jay Powell is speaking this week. What do you think? What do you think next year looks like for the Fed? I think we have 80 basis points priced in terms of cuts from now up until I think the end of next year.
I think the Fed has got a challenging period. I think we heard from Waller yesterday, and ultimately, the view is they still have very restrictive policy. They still view inflation on the right trajectory. They still believe the employment picture is softening. So, barring some of the data that we're going to get in the next couple of weeks or so, it does feel like they want to be easing policy again. I think next year is obviously going to be more a challenge. That first 100 basis points, that was quite straightforward. Yeah, we knew they were in very restrictive territory. Get those rate levels down. They probably need to see further momentum on inflation hitting towards 2%. They probably need to see a bit more softening in the jobs market to continue to go through next year. And then they're going to be waiting to see what the new administration puts in place. I mean, we have heard from Powell they're not going to speculate on what happens, but obviously it is going to have a big impact on what happens next year. I still think they're in an easing bias, but I would expect that they're going to be easing less than I would have thought pre the election.
So if you've kind of got that level of uncertainty around sovereign debt, do you want to be looking more at corporate debt instead?
I mean, I think so. And I think this is where the challenge becomes as an investor base, because when you break down corporate debt into sort of the fundamentals, the technicals and the quantitative, fundamentals from a corporate standpoint look very healthy. We've come through earnings season. We continue to see earnings growth, revenue growth, margins looking fine. Corporates fundamentally look great. And then technically we're seeing those, yield buyers. We're seeing a lot of flow into the credit market. It's that spread valuation that always comes into question. Like, how do you really want to, or do you really want to be buying these spreads given we're at a couple of decade lows? My pushback on that would be, well, you have got those incomes buyers back in. That will keep spreads pretty well contained. And we've just seen these periods historically, the mid-90s, where we dipped below 100 basis points in 92. We didn't go back above 100 basis points in spreads until 98. 6 years. We can have these periods. We saw it in the mid-2000s as well. So just because you're not really expecting spreads to tighten a lot doesn't mean you don't want to own credit, because you're still getting that incremental carry that compounds over the course of a few years. That's really important.
So spreads will tighten further next year? Is that still a safe... And I guess what's the risk, though, that is not too obvious to many people?
I think the biggest risk out there is that you have a Federal Reserve that has to reverse course. Now, whether that's because the employment picture and the inflation picture doesn't go in the direction they feel, or that we get policies out of the administration that reignite some of those animal spirits and pushes inflation back up, and if the Fed has to pivot and go back towards tightening policy, then I think that's going to concern risk markets. Risk markets are obviously very much supported by this sort of combined impact of expecting positive on the fiscal side, yet you've got a central bank that's easing policy. If that shifts, and on the central bank side, then that will be a concern. Definitely not base case at the moment, but it's something to keep an eye on. I think it's difficult for spreads to tighten much from here. I think it's more a carry environment, but as I said, you can get that carry. It's inflation beating at the moment. I see a lot of investors who just want to buy high-quality credits at the moment because of your point, is it better quality than the sovereigns?
Speaking of sovereigns again, how are you thinking about the relative attractiveness of the US to Europe then?
So on a valuation basis, you obviously look at all-in yields and think, US, much better than Europe. You've got over 200 basis points of extra yield there. But I just feel the central bank trajectory is different, and I actually feel the growth dynamics are different. So much more comfortable at the moment owning German debt and German rates than the US. I feel that spread can continue to widen. I think the ECB, we're debating 25 or 50 for the ECB. We're debating 0 or 25 for the Fed. The ECB has much more, I think, of a mandate at the moment when you look at the growth picture. Inflation is coming down, and then they've got the concern about what happens if tariffs appear next year.
Your thoughts around duration going into next year? You mentioned, investors should be happy with the spreads currently, even if they don't blow out, even if they don't tighten as well. There is the carry there. How far up the duration curve do I go then?
I think actually duration is firstly good because you do get that carry.
Yeah.
I think it's also a positive that we saw it's back as a diversifier. Bonds are back as a diversifier. Finally. If you think back that first week of August when we had that tough July jobs report, we saw the stock market in the US down 6% in a matter of days. US US aggregates bond indices are up 1.5%.
Yeah.
So bonds doing what they're supposed to do. And I think that's what happens in a world where inflation isn't too high and the central banks could react, because we're discussing, well, maybe the Fed cut by 25 basis points or not. If you do start to see material weakness in the jobs market and they start to get concerned about the possibility of recession, they could be cutting by 200, 250 basis points pretty quickly. We've seen that through previous cycles. So I think owning your bonds for that income, for that carry, makes sense, but also for that diversification aspect.
And is the investor psyche back to that? Is that an easy sell right now? Because people seem to have still, they got burnt on these as correlations snap back together. And I'm wondering where we are as far as, your conversation goes with clients.
Yeah, I don't think it is easy to sell. You're right, because obviously bonds had a horrible period during 2022, and then they've sort of meandered around at these yield levels for a while now, and they've been pretty volatile. I think once you actually get, if we do get, if the Fed cutting rates in the December meeting, we could well be in an environment where you're looking at cash and tens are pretty much at the same level. Yeah. First time we've seen that for a couple of years.
Yeah.
So again, I think that can come back into the investor psyche. Sometimes it's difficult if you're sitting in cash. Do you move out into government bonds if you're actually giving up yield? But if that yield's comparable and you then get that protection if things go wrong, again, the argument for owning high quality bonds makes a lot more sense.
How are you thinking about China? Because, of course, it's not just the outlook for easing there, but it's also the uncertainty around tariffs. So do you see any play for China in your portfolios?
Yeah, if I think about our global portfolios, we're actually marginally long China rates, and I think the reason being is there is all this uncertainty out there. Very unlikely that we're going to see higher rates in China anytime soon. You're still getting a lot of uncertainty around what happens on the tariffs and what happens next year. Now, if they're going to have to do more fiscal to support that, they're probably going to want lower rates to fund that. There's a lot of liquidity being injected into the system at the moment. There still seems to be a lot of demand. When I talk to my team here, still seems to be a lot of demand for Chinese government bonds. So, thinking about it from a global standpoint, only a little bit of Chinese duration makes sense as well.
Yeah, record lows now on the Chinese 10-year yields, 1.98%. Nice to see you.
Thank you very much for having me.
Let's see you again soon, and have the rest a good few more days in the Asia Pacific. What day is it today?
It's Tuesday.
It's Tuesday. Okay, you're off. It's always a Monday for me, isn't it? Ian, fantastic to see you. Ian Steely there, International CIO for Fixed Income at JP Morgan Asset Management. Okay, I need a coffee. Where's my coffee? Coming up next, might need something nuclear, in fact. We'll get that coming up soon. Ray Chen joins us out of Star Taurus Fusion, out of the PNEF Summit taking place in Shanghai. He's the CEO there, so we'll just get an understanding, really, of the technology. And will fusion be at some point a reality quite soon, I think is the question there, Belle.
Yeah, that's right. It's nuclear fission or nuclear fusion. It seems like fusion is the answer, but could be several decades away. Counting down to the open of trade in Shanghai, Shenzhen and Hong Kong, this is The China Show.
It's Jobs Day, and Bloomberg has the report under surveillance.
Who do you think holds the leverage right now? Employers or employees?
It's more balanced than we've ever seen.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market weakness we saw in the summer was a head fake.
What raises this question, basically, has the narrative been set?
We are still in the throes of a strong labor market.
The November Jobs Report, Friday on Bloomberg.
Good morning and welcome back to the show. Just in time here for the midpoint of the day, and the reason I guess this is fairly significant today more than previous days is the dollar onshore rate. So CNY is within a hair of a fresh year-to-date low, and we're within 1% basically from hitting a 17-year low against the U.S. on the onshore. Anyway, we'll see how that trades. Bottom of your screens is the midpoint of the day, just under 720 against the U.S. dollar. And all that being said, putting everything together, we have a rally taking place in the equity market, 2 straight days. We have a rally in the bond markets. We talked about the currency sectors to watch, chips on the on what took place and what was announced, of course, out of the White House, and something that we knew. Solar stocks really gained substantially overnight. And some stocks to watch today, you have HKBN, which did get an offer from China Mobile. It's about a 40% premium from the last price. It's resuming trade today, so we'll see how that fares, and Kingsoft Cloud, which has not stopped rallying, was up a further, I think, 14%. Overnight, and we have John Lee, of course, briefing, the weekly briefing set for the Hong Kong chief executive at some point this hour.
Yeah, and what else we're watching today is the 2024 BNEF Summit in Shanghai, because that's also kicking off today. But it brings together executives, decision makers, industry experts in the energy transition, and one field that's being focused on is nuclear fusion. Now, that promises higher emissions-free energy yields with less dangerous waste. Joining us now is Roy Chen. He's the CEO of Startoris Fusion. It's a Chinese company specialized in commercial application of fusion power. Roy, thanks so much for joining us. I do want to just start to make our viewers aware of the difference really between nuclear fusion and nuclear fission. Nuclear fission is what's used today by nuclear power plants, and it essentially splits an atom's nucleus. Nuclear fusion is about bringing two nuclei together to create also a large amount of power, but with less nuclear waste. What is the state of this industry? Because we know that it can't really be commercial maybe until around 2050.
Okay, first of all, the difference for the fission and the fusion is that the fission is already, as you said, fission, the nuclear fission is already used by human beings now. As for the fusion energies, it's, to be honest, right, it's still undergoing, but the scenario has been changed due to the how can I say, the relevant technology advanced. So nowadays, I understand that you said that the timelines for the used to be the 2050s, something like we still need 50 years to get that. But nowadays, I think there are like 50 commercial fusion companies around the world. About 70% of the companies are aiming to build the first demo, how can I say, demo fusion power stations around 2035, something like that.
So you want to have demo facilities or some demo facilities by 2035, so in about 10 years from now.
Yeah.
But when do you think that will actually be large-scale, widespread, major use or creator of power?
Okay, I think if the demo works well, I think we still need like 10 years to go, something like that.
Okay, understand. So what are you guys busy with, given these very long time, longer-term timelines, 2035, 2050? Give us a sense of how you're managing your business's strategy at the moment.
So our business strategy is, I think it's not a typical, how can I say that, not a typical commercial problems, right? Because we need, so first of all, to build our demo fusion power stations, we need like a lot of capitals, and we need, a reasonable amount of times. Therefore, that we need to get capitals from the from investors, right? I think this is the first thing we need to fix. This is the first things we need to fix for our companies, and I think the second is that the group members. So the fusion technology is one of the most difficult energy problems for the human beings. I think therefore we need to recruit the top talents from all area of the engineering side. I think that's the two major problems for our business.
What's the fundraising environment like for this type of technology in China in particular?
Okay, I can give you roughly numbers. So China are ranked as second in the amount of money raised in these typical sectors. Of course, the U.S. will rank once. I think in the past 3 years, the U.S. firms has in total raised $5 billion. And for the Chinese companies, I think in the last 2 or 3 years, in total have raised $500 million.
Okay, well, how much money do you need? For a business, for example, I want to understand what your CapEx plans might be and if you are fundraising.
For our companies, right?
Yes.
Okay. So for our companies, I think we need like around $1 billion, something like that. $1 billion to build our demo fusion power station.
Okay, and if you could give us a sense of what the regulatory environment is like, what government regulations are, government support for nuclear fusion, for example, and how far advanced do you think China is compared to the rest of the world when it comes to this specific technology?
I think first of all, it's not only for China, it's because the bright futures for the fusion energies, right? The fusion energy is widely regarded as ultimate energies for the human beings. Therefore, it's like not only for China but also for the worldwide. So you will find that there are lots of policies has been making, especially in the U.S. and Europe. But for the China's, we're kind of how can I say that? For China, especially in this year, I think the last years China has built our own national-owned enterprise in Hefei, and also we got like 5 commercial fusion companies at the moment.
Roy Chen, thank you so much for the time. This is a fairly complex topic, so we want to speak again, of course, in the future. CEO there of Sartorius Fusion joining us there out of Shanghai, where of course our guys at BNAF are having a conference, of course, around the topic. We're looking at shares of HKBN. We're up 7%. The buyout offer, of course, from China Mobile represents about, I think, a 40% premium. We'll talk more about that. And the transaction size, given the current price, $880 million. That is plenty more ahead. This is Bloomberg. Okay, we are poised for a third day of gains. Why not? On the Hang Seng Index, although quite modest, I should note, but it's still green on your screens for about third straight day. We should be on 2 days of gains on the onshore market. We'll see, of course, what happens in the opening bell. Some stocks to tell you about.
Yeah, big movers in the session so far. HKBN is one of those. That's the broadband company or provider in Hong Kong. China Mobile is making a takeover bid for that company, valuing it at about $882 million. Welcome back. You're watching The China Show, counting down to the start of trade in Hong Kong, mainland China. And as you said, Dave, yeah, maybe another day of gains for equities here, looking for a third straight day in the green. We had the eco data to start the week, the PMI readings rebounding strongly, particularly on the private side. And then I guess you've got that flow across from Wall Street as well. We're seeing some positivity coming through in tech in particular. Yeah, I think the Taiwanese market is doing quite well going into today because of the, we're led by tech. And, we're sandwiched between crucial Fed speakers who seem, at least mostly seem to be backing a rate cut. If 25 basis points. Yeah, if we don't get a nasty surprise in the data, of course, Jay Powell has the opportunity to cement that view midweek, of course, when he speaks. In terms of the equity market, as Bell was pointing out, we are looking at, well, we were past tense. We'll see what happens. Second day of gains onshore, the CSI 300 opening just below water right now. I think what's more encouraging, though, is when you look beneath the hood, like things like turnover, for example, which rebounded this week. Again, north of, I think, $1.5 trillion onshore yesterday. Shanghai Composite, the other thing we're tracking, of course, is that 10-year yield. Check that out. First row, leftmost side, we now have a 1.98 handle on the Chinese 10-year yield. 30-year yield, 2.17%. I think over the last 3 weeks or so, that
dip below the Japanese 30-year yield, which is maybe something to take note of. Right, let's have a look at the Hong Kong market, please, at the open. So at some point this hour, John Lee, the chief executive, is set to speak. Watch for that very closely. Flat open after 2 days of gains. Oh, okay, 3 days of gains. We'll see what happens with this. The other thing I'd like to point out is BYD here. BYD now here on your screens. I think it should be on your next board. So the company is planning to double, I think, its target for its Brazil factory in terms of job count. So 20,000 workers, I believe, is the target there for BYD. Leading gains in the early goings. Kingsoft Cloud, 0.25%, big move up in ADRs overnight. And the two other stocks you see bottom of your screens, let me just look for my story so I can get this properly for you guys. So China has found 4 rural banks in the Jiangsu province. 2 are listed, 2 are private. The 2 listed are those on your screens right now. They found them guilty of manipulating prices in the secondary bond market. There we go. That's the news there as far as those 2 are concerned. And back to the currency market very, very quickly. Dollar China just opening up right now onshore, and we are within 1% on the onshore rate, 727, of hitting the high that we hit, I think, back in 2023. Beyond that, it's back to 2007 levels here on the Chinese currency. Back to my student days in Shanghai, I believe. I was still, I was still exchanging my money at 8.2, if I'm not mistaken, back then. But yeah, so the tariff premium and defense out of the PBOC is back in fashion again, Bill.
Yeah, and you sort of wonder how the direction of the yuan is also going to be determined by what happens with the debt space as well.
Yeah.
Because yesterday was the story about the 10-year government yield hitting a record low. You were below that 2% mark as well to start the week. So it's been an unrelenting bond rally in mainland China. Let's bring in Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu joining us. And actually, we just had a line crossing here. The yuan has hit its lowest in a year amid worsening economic sentiment. But let's just start with bonds. And where do we go from here, essentially, do you think, on the 10-year yield?
I think the direction is very clear. Actually, it has been the headlines a few times this year, record low in the 10-year yield. Yeah. Of course, the PBOC then in the second half of the year, they start to sell the long-end bonds. It helped a little bit, especially the stimulus announcement in September. The 10-year yield did rebound a little bit, but then at the end of the day, the macro is still very fragile. And market is waiting for the next easing. Now, obviously, December, the PBOC governor said himself they may cut triple R for another 25 to 50 bits. Next year, they're going to have to cut further and also rate cut as well, at least 20 to 40 bips. So with that expectation and the economy is not actually improving, I think yields has to head lower from here.
And the tariff threat too on top of that. It seems like all the factors are stacked negatively against the Chinese currency. How does the PBOC manage the move down in the currency amidst some of the things that they might do, like cutting, of course, some of the interest rates still?
I mean, for currency specifically, we can see they're defending via the fixing. And it's not something new. Over the last few years, of course, the story was about the Fed hike, but now we are back to the trade war. So back in like last time when Trump was around, they just had to defend so hardly. But this time it's more difficult because last time China was much better, at a much better place before COVID, before the crackdown and the property slump. But now China is facing all this and yields are lower. So it's harder to defend the yuan. So.
What about the yen then in Japan? Because this is also facing that yield differential story between the US and Japan, and it seems like the yen carry trade is back in popularity.
I mean, certainly, if you look at the data, the CFTC latest data, we saw the net speculative yen short back in negative. So negative 11% as of total. Now, of course, it's still far above the net short of 80% before the unwind in July and August, so there is still room to build. But I mean, at the end of the day, even if the BOJ hikes, say, this month or even in January, the policy rate in Japan are still below 1%. And for the Fed, we're talking about near 5%. That gap, so of course, yen could rally upon a BOJ hike, but after that, market will start to rebuild every time, basically.
The question for many people now is, can Japan provide a disruptive event the way we saw back in August, whether that's a carry unwind, whether that's a rate hike, whether the yen strengthens? Do you see that? Do you see the possibility?
I mean, they can certainly hike rate this month, if not in January. But then, like, given the positioning market, we saw the net yen short, as I just mentioned, is somewhat light. Even in the dollar DXY futures, is still somewhat light as well. So we're not going to see a disruptive move in the yen like in July, August. But if the yen short start building towards 2025, then maybe at some point next year, especially with trade war happening, then certainly there could be more volatile market.
So should we expect the dollar to strengthen shorter term, you think?
Oh, for sure.
Okay, definitely. There we go. Keep your money in dollars. Good for us.
It is good for us, yeah.
Right? Yeah? Thanks to the peg. Thank you so much. Steve.
HKMA.
Yeah, PEG, P-E-E-G, not egg. Stephen Chu there, thank you so much, our Bloomberg Intelligence Chief Asia FX and Rates Strategist there. Very quickly, market check. We're now down 0.5% on the CSI 300. Hang Seng Index is still just above water. Hang Seng Tech is just below there. So, yeah, plenty more ahead. This is Bloomberg. All right, here's the thing with live news. Just a couple of seconds ago, we talked to our producers to say, okay, we got to check the currency because it was trading above 730. But look at where it is right now.
Very close.
Very close, but yeah, past tens for now. Yuan hitting the lowest in a year. I get just to mention as well, it has been a stronger and a weaker renminbi story, I think, too.
Yes.
Yeah.
Yeah. I mean, we saw the dollar snapping 3 days of gains overnight, just to mention. But what else we're tracking today is what's happening in the chip stock space. And this is, I guess if you want to say that offshore yuan also has some reflection of the tariff risk.
For sure.
There is that rising tension between the US and China. SMIC is sort of the lone one under pressure so far. But actually, there's maybe a little bit of relief coming through with some of the chip names in Asia today. We did have new restrictions from the US on China's access to the most advanced technology, but maybe the rules didn't go quite as far as they could have. So that is playing into the dynamic this morning. But let's get more with our China correspondent, Min Min Lo, joining us, and also our Bloomberg Intelligence senior analyst, Robert Lee. And I think you're talking about Intel this morning, Robert. But Min Min, start with you. The new restrictions, what exactly are they and which types of technology are they talking to?
Yeah, so this has been a long time in the making. So what's new is that Washington is now adding 140 Chinese companies to an entity list. This requires other companies to seek special license to sell any American technology to these blacklisted companies. The second thing they're doing is to limit the sale of high bandwidth memory chips. These are chips that handle data storage, essential for AI applications. It's on top of the existing curbs on these advanced logic chips, which typically function as the brains of devices. And the third thing they're doing is to limit the sale of gear, at least 24 types of manufacturing equipment and at least 3 software tools that are affected. And again, these restrictions apply to foreign products as well as domestic products made in the US, because Washington is invoking the FDPR, the Foreign Direct Product Rule, that allows them to control foreign products made overseas as long as they use even the tiniest bit of American technology.
And what is the intention, and how has Beijing responded, or how have some of the companies affected responded, if at all?
So for the HBM chips, obviously, it's going to be SK Hynix, Samsung that are affected. And then for the gears, it's going to be Tokyo Electron, ASML. But then these two companies, they are exempted because the Netherlands and Japan are exempted from this whole architecture. These two countries have been under huge pressure to match those restrictions, but they've been pushing back against that. What Washington is saying, they're justifying this by saying they want to prevent China from getting the technology that could help them modernize the military and even suppress human rights and basically threaten U.S. national security. But then Beijing is, of course, opposed to this. They say that this is a form of economic coercion. It's abusing the export control measures. They are vowing to take every necessary measure to protect their interests.
So, Robert, let's bring you in and for your reaction on this. It seems like, based on the trading activity, we're seeing that there's maybe some relief. But what do you make of the new rules?
No, first of all, I don't disagree with anything that Min Min said. I think there were fears that the Japanese and Netherlands would get caught up in these restrictions. So the fact that they have been exempted is probably a positive, which is maybe why you see some sort of relief amongst investors. But the direction of travel has been clear for a long time now. So this is a further tightening of the rules, and perhaps we'll see another step to tighten rules further at some point down the line. But this is part of the geopolitical tensions that we live within.
Just to get your reaction to the Intel story, which is the other big news that somewhat expected, let's say. Bill might have a comment on that too.
Well, I mean, he just had a very ambitious turnaround plan, and he had to try and execute on that. And it seems like the board has maybe lost confidence in him and perhaps shown him the door.
I totally agree with that. The writing has been on the wall for Mr. Gelsinger for a period. You know, Intel is strategically challenged, just not on a short-term view, but if you understand and are familiar with their history over the last 20 years or so, because predominantly it's a business whose it's a company whose business is predominantly tied to the PC sector. That's an ex-growth market. They've been looking to diversify first into mobile phones. That didn't really work for them, and more recent years into foundry. And again, it's been incredibly difficult for them to execute. I'd say they've had a little bit of bad luck along the way, but ultimately the strategy isn't working, and you know someone's got to carry the can, and it's Mr. Gelsinger.
It does seem, though, that whoever is the next CEO is going to face the exact same challenges. So finding someone to take the new role could be a difficult task. But how do you think Intel, or what do you think Intel does from here with that turnaround strategy?
Yeah, well, there have been some other questions about who would be the most appropriate person to take over, but it has to be a turnaround expert, someone with a proven track record in turning around companies within the space. Exactly who it would be remains to be seen. But yeah, there are no easy options. And looking at the stock price reaction last night, I think it rallied 6% in the, before the market opened, and then came off afterwards because there are no easy choices to be made. So I think Intel needs to return to the growth curve, and obviously the major growth driver in the industry at the moment is AI. And if you compare and contrast, not just with Nvidia but the likes of AMD, AMD was the second-tier company within the industry going back sort of 10 years or so, and they've done a fantastic job in turning around that company, in selling off their manufacturing businesses and focusing on the design. So I think, getting a better positioning in AI is part of the answer for them, reducing their cost base because they maintain this very integrated device manufacturing model, which is very cost-heavy, so trying to address the cost base. But again, there's going to be no quick and easy solution for them. So it's not a task I would want to undertake myself or wish whoever takes it on the best of luck. I think it's a multi-year challenge for whoever takes it on.
I mean, certainly it's an easy thing to say, go big on AI. And the question now is, do you think a breakup is the first step in the right strategic direction here for Intel?
Well, again, we could talk about this for half an hour or so, and appreciate we don't have the time.
We have 30 seconds.
Yeah, if you look at what AMD did, AMD hived off its fabrication activities to become global foundries. Looking back, that was, a fantastic move for them. With hindsight, Intel should have done something similar. But, they need to regain the growth curve, and there's no easy option for them at the moment, particularly when they're playing catch-up, not just on manufacturing, but within AI design as well.
All right, certainly a big challenge ahead, and exactly to your point, you sort of had that euphoric reaction with Intel rising 6%, and I think it settled about 0.5% to the upside. So really a lot of uncertainty ahead. But that was our China correspondent, Min Min Lo there, and also our Bloomberg Intelligence senior analyst, Robert Lee. Thanks very much to both of you. Some of the other top corporate stories that we're watching this morning as well. A Delaware judge has once again rejected Elon Musk's record-setting Tesla pay package, even after shareholders supported reinstating it. Kathleen McCormick decided to stick with her original finding that the company's board was under too much of Musk's influence at the time. The stock options package was worth $56 billion by the time McCormick cancelled it, and more than $100 billion at the Monday closing price. Bloomberg has learned that SpaceX is in discussions to sell insider shares that could boost its value to around $350 billion. That would be a significant premium to the $255 billion valuation reported last week. It would also cement the status of Elon Musk's rocket and satellite company as the most valuable private US firm. The Biden administration is offering $7.5 billion to finance a battery hub in Indiana. The conditional loan for a joint venture between Samsung SDI and Stellantis is expected to fund 1 or 2 lithium-ion plants in the city of Kokomo. The funding could be cancelled by the incoming Trump administration if not finalised by Inauguration Day. US agricultural giant Cargill is cutting thousands of jobs globally after missing profit targets. An internal memo says the largest privately held US company will cut about 5% of its 164,000 staff. Cargill's seen earnings shrink on lower corn and soybean prices, while the US cattle herd was the smallest in 7 decades. We'll have plenty more ahead. This is Bloomberg.
Welcome back. You're watching The China Show. Fortescue founder Andrew Forrest says that he's optimistic about the global energy and these transition efforts, of course. That is despite a recent setback at the UN Plastics Summit where nations failed to agree on a treaty to curb plastic pollution. Now, he spoke to us exclusively from the Bloomberg NEF Summit taking place in Shanghai.
The failure of that summit was utterly predictable. You know, the fossil fuel sector sent 300% more lobbyists than there were countries represented. You have this what's called a consensus, but it actually means everyone has to agree. So one plastic producing country can just stop progress for the entire world. So it's clearly a system which isn't going to work. That's now proven after a 5-year lesson. We have to go about it another way. Plastic is harming human health. It's harming the whole ecology of our planet. It must stop. And, you know, these people really need to get their head across it. But as to the energy transition, Hardin Sherry, yeah, look, there's issues on the horizon, but am I optimistic? Am I close to the breaking technologies which are coming down the barrel at us now? Yes. Fortescue's, yes, I am. I can see the changes coming. And basically, if North America wants to slide back into oil and gas, coal, you know, good luck to it. Its citizens, its companies, its investors will put up with this gyrating energy cost. They will put up with the fact that their cost of living from energy will be dictated by despots, dictators, oligarchs, who they will never know. When you've actually got this massive social transition happening in the rest of the world where the power is coming out of these huge companies and players into the hands of the people, into households, into companies, even countries. And that's this massive social transition, which the fossil fuel industry can see its grip sliding down the pole, and it just has to happen. Economically, look, am I really excited that we've got technology that can charge our trucks at 6,000 kilowatts in half an hour, that can charge cars in 30 seconds? Am I excited that we're bringing down the cost of making hydrogen massively? Yes, I am. And I'm just seeing this massive transition in history happening. And if those countries who follow renewable energy will grow stronger, take China, and those who don't will slide back, take North America.
You just mentioned North America, so let's talk a little bit about President-elect Donald Trump. I know that his transition team has already approached your team. Have you had direct conversations? And how will you try to change his mind when it comes to really fossil fuel and the reliance on oil?
Look, President-elect is an economic pragmatist, and he's also won an election in large measure on creating fear about the wind back on renewable energy, creating fear about China. You put these two things together, there's one country being enormously economically pragmatic, Sherry, and that is China. It will account for 50 to 60% of all the solar energy both produced and installed in its own country before the end of the decade. It will have this rising and steady growth in standard of living of its citizens. Those who pull back on it, who've created fear by saying, hey, look, cost of living might go up. Now, you know, there's a war in Ukraine, there's a war in the Middle East. Let's not change now. It's a bit risky. Well, actually, that is the time to change. And of course, North America has this wonderful opportunity to go surging ahead for its citizens. But if it tracks back to oil and gas, Sherry, it's just going to see this economic transition happen. You've had the Chinese economy once easily the biggest in the world centuries ago, and it'll just go back there quicker now.
That was Andrew Forrest, their founder and executive chairman of Fortescue, speaking to us.
Give me back my phone. Stop hiding my phone.
I was having a bit of a tech issue that I think maybe some people saw. But anyway, check on the markets because we are 23 minutes into trade so far. And actually, most of the activity is coming through what we're seeing in the FX space today because we just had the yuan hitting 7.3 and actually offshore, it is still trading at that, but it is the weakest we've got in a year. So there's certainly that worsening economic sentiment that's playing into it, that expectation around easing Trump tariffs. What does that mean? I mean, it's not a great outlook really for the Chinese currency, especially when King Dollar, we were just speaking with Stephen Chu from the BI team, saying it's expected to persist for quite a while yet.
Yeah, even if the Fed cuts, right? The rate differential is just so substantial right now, and the other things that are weighing on the yuan for this to remain at these levels. In fact, in the next hour, we'll be joined by UBS, of course, who'll be taking us through their FX and commodities outlook going into next year amidst the China story. The other thing taking place in the Asia-Pacific following the rally on Wall Street is this tech rally. So Taiwan's up to 23,000 right now, 1.5%. South Korea and Japan are doing all very, very well. And Singapore, of course, which yesterday touched, rose at a high in 17 years. So I think we're still within 2% of a record high in that, I guess, which is a few days away. And the French story, of course, continues to give.
You've got the French government on the verge of collapse. A no-confidence vote could be called for as soon as midweek. Certainly questions the far right agitating for changes to the budget. I think even if the Barnier government were to concede, that still doesn't really do anything that's great for the outlook for bonds because there's concerns around the fiscal responsibility of the government as well and what succeeding or seceding to the far-right demands would mean. But more ahead in the next hour, as you said, talking with UBS Global Wealth Management. Welcome back to the China Show, taking a look at the CSI 300 half an hour into the session. And you know what? We started the day with some notes of positivity and we thought maybe it could be a third straight day of gains where flipped into negative territory. Trading volumes are also a little bit thin. There's a couple of things on the horizon this week. You've got Fed speakers, of course, and you've also got jobs figures and just broader uncertainty around what happens in China as well with the outlook for easing, economic outlook, and also what happens with Trump back in the White House. So really lots of headwinds facing Chinese equities.
Absolutely. In fact, I think to Belle's point, right, we hit 730 on the exchange rate a couple of minutes back here, which now takes us to the highs of the year on dollar onshore and offshore. More on that in a moment. The other big story that we are continuing to track is this implosion. Is that a good way to put that? That's taking place in France with, I think, the premium over bonds now at the highest since 2012. Credit default swaps are at 41 basis points, which effectively is the most expensive cost to insure going back to 2020. Oat futures started catching somewhat of a reprieve going into today, but again, the other play, of course, is via the euro, which is trading below the 105 handle there. But that's also perhaps also a stronger dollar story. Asia ex-China, the equity market, we're actually doing quite well across the region. So almost every single market, with the exception of a few like Greater China, is doing quite well. It's 0.7% to the upside on the Asia-Pacific benchmark. Nikkei is up 1.7. The Korean market is up 1.5. Taiwan is up 1.5 as well. And Singapore, which hit a 17-year high this week, is continuing to add to those gains. So we are approaching the highs we hit last in 2007. Now, speaking of 2007, I'm not sure who recalls this, but the exchange rate on the dollar China was at 8.2, I believe, in 2005, through to 2006 when I was still a student there. And then they revalued it to hit, I think, 7.2, if I'm not mistaken. Anyway, we're back to 7.3. So a little bit more, we take out the high that we hit back in 2023. And beyond that, we're back to 2007 levels on dollar China. Do we get there? Dominic Schneider is here with us, head of global commodities and Forex at UBS Global Wealth Management. Nice to see you.
Good morning. Glad to be here.
Why don't we start with that? Dollar China, how high do we get?
Well, I would say next up is 7.5. I think that would coincide with some rate differentials. You look at the 2-year rates differential. That point, at this point in time, 7.3. But I would think about that, you know, the exchange rate can overshoot. So 7.5 is the first stop. Can it go higher if you take what happened during 2018? Yes, it can. So I think investors need to prepare for a weaker currency. And in that context, you want to be hedged some of your CNY, CNH exposure.
What's the level of comfort, though, the PBOC is going to have with the yuan at that level? And do you think we see any sort of pushback?
Well, we already see actually a pushback. So I think that will continue. I think we need to be clear that some of the movements we have seen in dollar CNY right now is more broad dollar strength, rather genuine CNY weakness. The genuine CNY weakness has yet to emerge. I think there are two elements to it. Number one, obviously speed at how things move. 7.5 is not dramatic. I think where it becomes problematic if a weaker currency lead to a currency crisis or a perceived crisis, that knock-on effect on consumers. And if consumers hold back and would somehow affect the economy on a more broader scale. That's where obviously you want to circumvent. What I'm not a fan of is to have a red line in a sense. In currency market, that never works. So here I think at this point in time, a cautious PBOC trying to focus on stability, but that still means 7.5 we can reach quite quickly.
And just the other side to that, you mentioned a lot of it is also the dollar strength. And where would you fade the dollar strength against which pair, for example?
Well, at this point,
is it too crowded right now?
Well, it's definitely crowded. I mean, we have seen a one-time standard deviation move. You take, for example, the DXY. Could it be more? It could be more if you think about Trump really going to be a step change for the U.S. economy. I still have my doubts. I mean, there's two things. Tariffs, well, everybody at this point in time focus on what's the damage for the rest of the world. Well, it can also put damage to the U.S. There are some studies out there that you might lose growth by 0.5 percentage point. So that's something to think about. And that's going to come next year when we see retaliation kicking in. So I think that narrative the market is not playing. And I know everybody says, oh, higher inflation, that's why Fed can cut less. But the impact of inflation might be not that great. And so I still see room for the Fed to cut. And right now, there's not much price for the Fed cuts. So maybe we see another 25 or 50 basis points more beyond what is priced. And that takes off the edge on the dollar. So I rather would sell the upside at this point rather than chasing a stronger dollar, with the exception of the CMY.
Yeah, we've actually been speaking with or hearing from different Fed officials this week. Jay Powell's going to be speaking as well. But the Fed Reserve Governor Chris Waller also talking about his leaning toward a December cut for this year. But take a listen.
I lean towards supporting a cut to the policy rate at our December meeting. But that decision will depend on whether data that we receive before then surprises to the upside and alters my forecast for the path of inflation.
So I think, I mean, if you take a look at swaps markets, a 70% chance of a 25 basis point cut later this month. But going into next year, how does that Fed direction come up against sort of the uncertainty around those competing policies from President-elect Trump, do you think?
Well, I think the Fed made it very clear they're going to look into incoming data and not going to speculate what's going to happen. So they really need to see what is on the table and then make the decision. So they're not going to move on expectation. Probably you might have a looser fiscal situation, so the actual situation matters more. And coming maybe to the most important part, I mean, the U.S. runs already a hefty deficit. What do you want to do, Trump? You want to really widen your fiscal deficit? I think fiscal prudence is something we should focus on. And I think that's going to be an important line to watch in 2025. And will limit the way you're going to basically give reduce taxes, for example, and how you handle some of the tariffs.
Where's your head on the euro? For example, what is the conversation when you're in Europe, and how do you see the conversation while you're here in the Asia Pacific?
Well, there's not much trust at this point here in Asia. I think people do look at all the challenges that Europe faces. You mentioned the French situation that we have here, but also Germany, the energy crisis that we had, basically. So the wars around. So I think there's multiple issues. Though confidence here in Asia towards Europe, I would say, is pretty low. The story in Europe obviously looks a little bit different, but I think that's maybe we're blinded by the fact that we're living there. And so from that perspective, we realize we're not going to grow fast. And actually GDP surprise, okay? You can say there's some one-off, so we're not in recession, and some of our external balances have actually improved. So from that perspective, there's no need for the euro to capitulate towards parity and lower. But obviously we recognize that we have a growth problem, we have migration challenges that we need to solve, and so I think there is a lot of, I would say, limited optimism. Whereas if you think about the US, people do look forward at this point in time with Trump, whatever change that's going to be.
Yeah, I think we've actually got a terminal chart taking a look at the spread of the 10-year yield in France over Germany, and that has now hit a level we haven't seen since 2012. But it seems like, from your perspective, maybe neither of those look super attractive right now. Where would you be more favourable on in the region, do you think?
Well, to be honest, if you think about Europe, where I would be positioned is basically in the UK. Although we might run a little bit of a bigger deficit, I think it's clear that the Bank of England might not cut as quick. Probably the UK, the pound, one of the best currencies there to have, also given the yield by, I would say, next year. The pound is probably the currency with the highest yield within G10, and that's something to account for. So if you're a Swiss investor, if you're a European investor, having a little bit of pounds, getting better yield is something to focus on. With regard to France, I think they're going to get their act together, and ultimately there's still the ECB. Look, we were in bigger crises and we resolved it. Yeah. So don't get too carried away that this is going to lead to an implosion of politics, etc. I think that's a little bit overdone.
Big picture, going into next year, things like disinflation, can we trust that continues, for example? How low do we get a neutral? Is that shallower than we previously expect? What are your wild cards going into next year? So next year, I still look for disinflation to continue. I think that is clear. Well, the big part is behind us, so it's going to be a modest story. But then we can at one point, as I said, also in the US, go sub 2 is, I think, at one point possible still. I think the biggest risk I see to growth, there is a little bit of a step down in government spending, so contribution to GDP, that's going to step down. And I'm not as positive in the US with regards to the growth trajectory. Expectations have rallied up. So an element of disappointment here is still probably what I'm watching. And I think that reflects what we see in the FX market. We might start strong for the dollar, 2025, but we end on the softer side.
All right, Dominic, you're staying with us. That's Dominic Schneider there from UBS. We'll be back in the next break talking about commodities and the outlook there. But also ahead, we'll be back to the BNEF Summit in Shanghai, speaking with the Executive Vice President of ACWA Power. We'll discuss their renewable energy projects in China, as well as the potential for expansion overseas. Plenty more ahead. This is Bloomberg.
And Bloomberg has the report under surveillance.
Who do you think holds the leverage right now? Employers or employees?
It's more balanced than we've ever seen.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labour market weakness we saw in the summer was a head fake.
What raises this question, basically, has the narrative been set?
We are still in the throes of a strong labour market.
The November Jobs Report, Friday on Bloomberg.
Okay, let's briefly have a look at where we are in gold prices, which, in case you missed it, too bad on you. It's done very well. Well, a lot of people missed this. And certainly it's really come back in a very big way. I think the conversation this year has shifted from it's inflation hedge, whatever. Structural flows from central banks and a pickup from demand is something that we've heard a lot. So we are off highs of the year, but certainly there is a lot more upside. That's according to Dominic Schneider, of course, head of global commodities and Forex at UBS Global Wealth Management, CIO. How high do we get on gold, and why?
Target is 2,900. Okay. Rationale, you mentioned already, central bank purchases likely to remain strong. I think what we need to be clear, central bank purchases are not accelerating anymore. They're going to stay at a high level, so we're looking between 800 to 900 tons over the next 12 months. I think that gives us a good base demand, but then what needs to come on top is truly ETF purchases, and that must come with real rates. So real rates are on the higher side in the US. That needs to come down, and obviously We're still looking for a somewhat weaker dollar throughout the course of 2025. All that combination pushes us higher. Since we are already quite high, I think we shouldn't think double-digit. Double-digit can only happen if an accident happens. But I think otherwise it's very hard. You can have some macro or some econometric models that can support a move to 2,900, but as I mentioned before, that needs a weaker dollar, that needs lower real rates, and a depressed equity premium.
I've always wondered, why have flows from central banks picked up? Like, what's the rationale there?
Well, they have picked up after the war in Ukraine and Russia started to emerge, and central banks were looking to diversify a little bit out of the dollar. So that trend, we don't know how long it lasts. Let's be very clear. History would tell us they stay a little bit for several years, so it shouldn't be just a one-year affair. We saw it 2022, we saw it 2023. So purchases here, we see interest picking up when gold is back towards 2,550 thereabouts. So I think central banks are lining up to buy gold on dips. But I think that narrative is here, but we don't have that much clarity, let's be frank.
But you did mention that it's sort of contingent as well on ETF buying picking up. And does that happen as we have a lower rates environment? How does that play into it?
Absolutely. Well, ETF demand picked up, now came off a little bit in recent weeks. I would say still real rates. You'll look at how ETF demand behaves. If real rates come down quite in a sharp fashion and also the dollar comes under pressure, I think ETF demand can pick up if history is of any guidance. The thing is, speculative account in the futures markets are already very high. So the spec community's position, it's a little bit rolling over, so you're not going to get that kind of thrust. So it's really down to these ETF purchases and obviously also on the physical side that needs to make the next move for gold.
Your outlook for oil?
We're over $80 for next year. I think it's quite controversial because there's a lot of moving part in the oil market. Number one is OPEC needs, or OPEC Plus, really needs to hold barrels back. The issue is that demand growth is slowing, so we're looking at only 1.2 million barrels per day demand growth. And there's a lot of estimates out there that outside OPEC Plus, supply can really match that. If that is true, then the decline we've seen in inventory could reverse, and obviously that is a price negative factor. So we need to have OPEC in place. We think that's going to be the case, and so with inventories crawling down, we crawl a little bit higher. I think the best strategy as an investor is to sell volatility. Vol is low across most assets. I mean, it has also come down in oil, but the vol is nice, the curve is downward sloped, so
that's the play.
That's one way to looking for some yield pickup in a portfolio.
So how does the US dynamic play into it then? Because we've got, of course, Trump back in the White House and he's bringing in an energy secretary that's very favourable to drilling more. But is that really going to be what happens, do you think?
Well, probably they want to try to produce more oil. I think there's two things or three things to consider. First of all, cost economics. Let's be clear, if prices are low, you're not going to go for some of these wells based on our analysis. So that's one factor, so cost economics, so you can't really push things. The other part is, even if you make things easier to get permit, you get access to federal land, etc., there is a lag where until production comes online. I mean, some of these permits, to get everything done, you easily need 200 days. So whatever you decide right now comes with a knock-on effect towards the year end at best, or more into 2026. Look, our thinking is demand supply growth from the U.S. is going to grow, but it's probably more going to be 0.3 million barrels per day. It's an important contributor, but it's not going to change the needle at this point in time.
It feels like we're ticking the boxes here, just the wide array of your coverage. I want to ask you about base metals and China, things like copper, for example. How big of a wild card is China? And copper's come back a little bit this year. Have we seen the highs on copper?
No, I think we go back. I think energy transition not going to work without copper. So I think that's the longer narrative story. I think a more shorter term, what we need is China stabilizing. That's number one. Obviously, the government tries to do whatever it can to do so. So hopefully a little bit more is coming down the road. That's going to probably keep copper prices where it is. What we need to see for the next leg up is really a industrial production pickup in the US and Europe. And I think at one point next year, we're going to get that. I know it sounds a little bit too far-fetched, but ask yourself, when rates are down 200 basis points, You're not going to travel more. You're not going to eat more. But you're probably going to make an investment here and there. So I think a manufacturing recovery in the second half of next year is fairly feasible. And with that lift, we should see $11,000. So here as well, as an investor, what can you do? You can sell the downside. Vol is not great, though. Or you position yourself for that 11,000 longer-term narrative of 20% upside that we have.
What about the outlook for other transition metals like lithium or nickel?
Well, in case of nickel, I would say we have enough supply. So I think inventories are rising, wouldn't chase that one at this point in time. And I think also on the lithium side, we are not in a situation where we have a deficit market. So I think investors need to be a little more selective. You can't just go broadly. We do have a problem in car sales globally. So still probably a little bit downside to go. And I think first I want to see that kind of recovery in manufacturing. I mean, the PMIs are crawling up a little bit in the US, but not yet above 50. If you look at the ISM, Europe somehow stabilizing, but at really meager levels. So for these metals, let's wait until we get a little bit more growth confirmation before I would make an exposure. So really nickel is something I'd rather avoid, rather sell on rally than I would buy at this point in time.
Anything else we're missing? Whatever it may be, like what else is your big thing for next year?
Well, I think there's two things to think about. I mean, in the precious metal space, think about silver. Okay. We got some numbers out from Metal Focus. We got some figures out also from Silver Institute. So I think here supply is constrained. If manufacturing comes back, silver has 20% upside. So there's more to go. But obviously, for the person with the right risk appetite, this is a 30-40 vol asset, so quite volatile. Yeah. Also good for vol selling to beef up some of your money market return. Alternatively, think about the entire asset class. I mean, precious equities, metals. Entire asset class, commodities overall. Okay. Definitely, has underperformed equity for good reasons. But I think the lower correlation we've seen lately gives us a little bit of added value in terms of a broader portfolio. And there are factors we need to think about. I mean, on oil, some of the Trump nominations are hawks on Iran, so I think we need to watch that. Any supply losses could bring us higher prices. And so I think as a return diversifier, I still think commodities, some exposure makes sense. We're looking upside of almost 10% in 2025. Wow.
Dominic, thanks very much for your insights this morning. That was Dominic Schneider, the head of Global Commodities and Forex at UBS, Global Wealth Management CIO. And we'll have plenty more ahead. This is Bloomberg. Welcome back to the China Show. Some of the corporate stories that we're tracking this morning, and the Biden administration is offering $7.5 billion to finance a battery hub in Indiana. The conditional loan for a joint venture between Samsung SDI and Stellantis is expected to fund 1 or 2 lithium-ion plants in the city of Kokomo. The funding could be cancelled by the incoming Trump administration if not finalised by Inauguration Day. US agricultural giant Cargill is cutting thousands of jobs globally after missing profit targets. An internal memo says the largest privately held US company will cut about 5% of its 164,000 staff. Cargill's seen earnings shrink on lower corn and soybean prices, while the US cattle herd was the smallest in 7 decades.
Okay, let's have a look at some of these chip stocks across the region on the back of, some of the news flow coming through there on, well, I think not as bad as expected. Is that a good way to describe, of course, some of the chip curbs that were announced, at least relative to expectations earlier on?
The restrictions could have gone further, but they didn't. And so you're sort of seeing that relief coming through. And particularly names in Japan and the Netherlands have been spared. They're already, of course, restricted from selling a lot of their technology and equipment to China anyway. But we do see the likes of Tokyo Electron, for instance, up 4%. Disco, again, in the similar sort of space, 7% in the green. Yeah, as you say, could have been worse, not as bad as feared.
Yeah, and this is really leading to a broader rally across major benchmarks. These are some of the biggest stocks, if not the biggest stocks across the region. This is a fairly niche story. So within the Chinese equity market, some of these SOE venture capital stocks are actually seeing some upside, not to the extent we're seeing in the broader chip space as well. That's really on the back of authorities promising to support government-owned firms to set up their own funds for long-only investments. This seems to be one of the stories that will take time to gain some traction. We'll see more details. Markets are reacting somewhat to this. The other story we want to point out, too, is the HKBN story and the China Mobile story. So HKBN has now resumed trade today, and it's reflecting somewhat the move we're seeing based on the price. But you had a nuance to hit here earlier on China Mobile story, too.
Yeah, so essentially China Mobile's made an offer, or they're looking at making an offer for $882 million US, and that is at a 41% premium to the undisturbed share price, which is essentially the last close before details of the offer are made public. So that stock there, you're seeing the reaction coming through. China Mobile, a little bit under pressure so far. We're also taking a look at a chart.
Yeah. The Singapore market has actually silently creeped back into the top of the league tables here. So we've put a chart, a very, very simple one, a price one. So we've taken out the highs earlier on, and we're now within 1% of that all-time high back in 2007. Yeah, so watch this very, very closely. We're about 30 points, actual index points away from taking out that level. Yeah, so we have a couple of, I think, colleagues right now in Singapore for business. If they're coming back, do bring some goodies.
A pandan cake, please.
No, please. Nothing against the pandan cake.
You've had too many.
I've had it. If I see another one, I am going to flip, and that's going to go out the window, to be honest. But it's up to you. It's your gift.
Taking a look at a live shot of Tokyo this morning, 11:29 a.m. there, and markets about to go on their break. But it's been a very strong morning across the board for Japanese equities. You've got the yen, of course, in focus, just a touch stronger than the 150 level. Japanese stocks as well being led by what's happening in the tech space. In particular, we saw the Nasdaq, for instance, gaining more than 1% overnight, really outpacing the gains in the S&P 500, and some relief coming through that further US restrictions on exports of technology to China to try and curb their semiconductor industry haven't gone quite as far as feared. So we are just seeing some good moves in the likes of Tokyo Electron, which are major weightings on the benchmark. But let's also take a look at one specific stock that just flipped in, or is flipping into negative territory this morning. That's Nippon Steel, trading there. We did see it under pressure after we had some lines crossing. Well, Trump is saying, President Trump is, or elect Trump is saying that he wants to block the Nippon Steel, US Steel deal when he's president. This has sort of been the, will they or won't they let this proceed? But it's certainly a deal that's been very much caught up in the whole election cycle, essentially.
Yeah, and clearly it now becomes a decision for the incoming White House and administration of Donald Trump, right? So clearly, to your point, Joe Biden had very difficult challenges really trying to massage the narrative around this deal. The stock, in reaction to that Truth Social post from Donald Trump, dipped, as Bell was pointing out. At one point, we were below zero. As you can see, we're rebounding almost as quickly as things fell. But yeah, just to underscore that he will be blocking that deal when he's totally against U.S. Steel being bought by Nippon Steel. The other narrative across these markets going into the thick of Tuesday, and of course as the Middle East wakes up, and if you're up already, good morning to you, you're up a bit early today, is the tailwinds coming across this equity bull market across the region. So the U.S. again hit another record overnight. S&P futures are steady. Most sectors are up. We talked about the tailwinds coming through in the tech space, and as you can see, the MSCI Asia Pacific IT index is up 1.4%. That's enough really to lift most boats in the region 0.7% to the upside. That's the market story for now. There's also a lot of sort of merger and acquisition news that's coming through as well. A lot of the deals in the deal space today.
Yeah, it's quite an active morning. One of the ones we've been profiling, of course, is HKBN, and China Mobile has made a takeover bid for that company that would value it at close to $900 million. Major HKBN shareholder, that's the Canada Pension Plan Investment Board, is committed to accept China Mobile's offer. It gives it a leg up over rival suitor I2 Capital.
Now, Alibaba is investing 100 billion won in South Korean fashion platform Ably. Someone will correct me. Valuing the company at more than $2 billion. I apologize for that. In a statement, the company said it will support sales of Korean products to global markets while seeking to raise more funds from global investors. And the U.S. Justice Department has reportedly approved the merger of Korean Air and ASEAN Airlines. Now, South Korea's Mail Business newspaper says Korean Air has now won approval from 14 required countries. It's almost getting an APEC card here. Now, the combined entity would become the world's 10th biggest airline. Okay, from all the deal news out there, perhaps arguably the biggest one, and the news dropped this morning here, and this is based on our reporting, is SpaceX is said to be in discussions to sell insider shares that could boost the value of Elon Musk's rocket and satellite company to get this $350 billion. Let's bring in Peter Vercoe, our Global Business Asia editor, is with us right now. And, I mean, can we still call this a startup, Peter? I mean, $350 billion in valuation. Where does SpaceX now rank?
Yeah, well, it's quite a remarkable increase in valuation. Just last month, we'd reported that SpaceX was worth around $255 billion, and a year ago it was worth about $180 billion. At $350 billion, it becomes the most valuable private startup in US history. Just to put that in perspective, it's worth more than Boeing and Airbus combined.
Yeah, it's kind of interesting because the other sort of story around Elon Musk today is that his multi-billion-dollar payout from Tesla is being gutted by a judge in Delaware. But when you think about the valuation of SpaceX now, does it even matter for him?
Well, given that he's worth around $350 billion US anyway at Monday's close, you know, it's not like he's short of a dollar really. But yeah, he owns 42% of SpaceX. So if you just did a quick calculation there, you know, this increase in value for him is worth about $42 billion. But on the other side, his pay deal with Tesla, and this has been a bit of an ongoing saga. You may remember it was originally struck down by the Delaware court in January. Tesla took it back to shareholders at the original terms in around June, and it was approved again by shareholders. About 72% voted in favour of it, and now the judge has just come out again overnight in the US and struck that down again, saying that it wasn't a negotiation between Tesla and the board, but more of a capitulation by the board to Musk's demands for pay. Now, when that deal was first struck, it was worth about $2.6 billion. At the time it was rejected by the Delaware court earlier this year, it was worth about $56 billion to Musk, and at Monday's close it was worth about $101 billion to Musk, just given the increase we've seen in Tesla's share price, particularly since the US election. So, you know, it's not small change to him, it's still a big chunk of money.
And that's Bloomberg's Global Business Asia editor Peter Vercoe there, of course, talking about SpaceX, this tender offer at roughly a $350 billion valuation. But we're going to stay with the space. Clearance has actually been given for Australia's first ever commercial space launch. Gilmour Space Technologies is expected to make its first test flight within a few weeks and has already got Australian customers signed up, waiting to get satellites into orbit. Bloomberg's Paul Allen has more.
History will soon be made in this field in North Queensland. Gilmour Space's 25-metre-tall, 30-tonne rocket is cleared for launch by Australia's space agency.
It's really, really hard to come up with an orbital rocket, and you know, I'm happy that we've gotten to the point we have, and I really hope that the first launch goes reasonably well. Not expected to go to orbit. Historically, they never have, but we're going to learn a lot.
It's been a long time coming. Gilmour Space started its rocket program in 2015 and was initially expected to launch in 2023. Getting regulatory clearance has taken longer than expected.
You can imagine when you go to a regulator and say, hey, guess what? I want to launch an orbital rocket from Australia, the kind of first reaction. So we've spent a lot of time educating a lot of different people.
Customers are already lining up. First in the launch queue is Space Machines, an Australian satellite company that offers roadside assistance in space. Once in orbit, its mini-modules wait, deploying when needed to carry out repairs to other satellites. For Space Machines, having a local launch option will be a game changer.
I think it
gets rid of a lot of different costs. Having a launch capability in Australia will mean we won't have to travel much, we don't have to think about spacecraft getting damaged, having capability to very quickly turn it around for subsequent launches. So I think it gives you a number of advantages of having it onshore.
The significance of pushing through all the technological and regulatory barriers to get the rocket to the launch pad also can't be understated.
Adam's done an amazing job of persevering through all of that. There's a sort of almost a colloquial thing where US produces unicorns, I think Australians produce cockroaches. We need to survive. And in the process of survival is success.
In terms of survival, while the test launch for Gilmour Space is an important milestone, harder challenges are yet to come. A regular, reliable launch schedule and ultimately turning a profit.
In the last couple of years, we've just had continual customer demands for us to launch. And so, the customer equation's there, and they're as strong as it's ever been. So I think they understand once we get the technology right, our path to profitability is very quick.
As for liftoff, an exact date hasn't been settled, but space geeks keen to watch the show might consider a Queensland beach holiday for early 2025. Paul Allen, Bloomberg, Sydney.
And if you are a Bloomberg subscriber, you can catch up on all the interviews you might have missed here using our interactive TV function, TV Go. And you can join the conversation by sending us instant messages to our team, to us, for our clients. You know how to reach us, of course, during our live shows. Check it out. TV Go. This is Bloomberg. Welcome back. You're watching The China Show. A UN-backed global summit has failed to agree on a plastic pollution treaty. That's despite 2 years of conversations and negotiations. That's as oil suppliers blocked attempts to limit production. Let's bring in David Fickling, our Bloomberg opinion columnist, who thinks that while it is easy to issue blame, it doesn't absolve countries of really their overall responsibility here. He joins us out of Sydney. David, well, let's start off with a basic question here, I guess. Why did the meeting fall apart to begin with?
Yeah, I mean, I think with all of these things, it always comes down to the sides are too far apart. To get an agreement, you've got 190-odd UN members, and they all have to sign up to this, and this is the sort of early stage of that process. It's worth bearing in mind that quite a few of those UN members are major oil producers. And they can see that demand for transport fuel, the traditional core of oil demand, is peaking or in decline. Plastics is one of the few areas, petrochemicals, where demand is actually increasing. So why would they sign up to a process like this? I think when you look, when you look at where we are, this started from a UN resolution calling for an end to plastic pollution. That was the wording of it. The final thing that came out of Busan last week couldn't actually even use that phrase. They used it address plastic pollution instead. So I think it's a real sign that that it's getting increasingly hard to actually get any sort of global consensus on these sorts of issues.
This was supposed to be something that joined other existing UN conventions on areas like climate and biodiversity. The fact that it didn't get through, does that also then raise questions about the viability of those other ones?
Look, I think it does. We've just, fairly in rapid succession come off a meeting on biodiversity, and sort of most notably COP29 in Baku, Azerbaijan, that was widely regarded as a failure. The fact that it was in Azerbaijan at all caused quite a few of the, the major developed democracies to avoid the process altogether. The final agreement pretty much stepped back from previous commitments around transitioning away from fossil fuels. As I said, you've got a group of nations that really don't agree with the fundamental purposes of a lot of these agreements. And it would damage their economies if they do. So why would they sign up to it?
And David, we would be remiss of our duty as journalists and media if we don't place blame on somebody. Who do we send a letter to?
Yeah, I mean, I do think that's the one wrinkle with this. It's in a way I've been blaming the oil producers myself here. Obviously, also the world's biggest oil producer, biggest gas producer as well, is the US, where you have a Trump administration waiting in the wings that's not very friendly to these goals and would have to sign off on any plastics treaty that actually came out of this process. So this is possibly dead in the water from the start. But I think you actually also need to place a bit of blame on the consumers of this stuff as well, the developed democracies that, OECD countries that treat themselves as defenders of this process. They've often tried to pass the difficult political decisions that need to be made to reduce demand for fossil fuels onto these obscure UN processes rather than doing the difficult political work at home. We can see with the elections in US just last month how difficult that work is. But I think we can also see with these meetings over the past month that trying to sort of hive it off to a UN process to avoid the difficult conflicts that you'd otherwise face doesn't always work that well.
That was our Bloomberg opinion columnist David Fickling in Sydney there. And let's stay in the climate action space, head back to the BNEF summit in Shanghai now. Our next guest is in charge of the China operations of Saudi renewables company ACWA Power. Let's bring in Executive Vice President Yunhe Liu joining us this morning. And I think you've had a very busy program or agenda because ACWA last year announced plans to start developing projects within China, focusing on areas like desalination, green hydrogen. Can you share it with us today? Where do those efforts stand?
Thank you for having me. This is Yunhe Liu from Aqua Power China. We have a huge ambition of investing in China up to $15 billion by 2030 in green energy, renewable, green hydrogen, and desalination water. By end of this year, we are planning to have 1.3 gigawatt renewable, and we're going to have our first water purchase agreement signed with Weifang government in Shandong, and the construction will start next year.
Okay, so just to clarify, by the end of this year mean 1.3 gigawatts, just to clarify that goalpost.
Yes. By end of the year, we are going to have approximately 1.3 gigawatt of renewable capacity in China. Yeah.
Right, and specifically going into next year, then, what does that pipeline look like? And where do you think you'll be as far as capacity is by the end of next year?
Yeah, in terms of the capacity, by 2030, we are targeting 22 gigawatts. Next year, we are aiming to add additional 4 to 6 gigawatts, and the year after will be on average between 5 and 6 gigawatts every year. That's our plan. In terms of business development approach, we have 3 key business development approach. One is working very closely with state-owned companies in China to join hands with them, invest in China, but also bring them to invest outside of China in the international market. The second is acquisitions on assets and also the company platform. The third one is greenfield to the province where there is strong incentive to support foreign direct investment.
Talk to us more about that partnership then between China and the Middle East, because it sounds like you're saying that ACWA Power will be able to bring some of these companies in China outside the borders. Is that right?
Yeah, I'll give you one, maybe several concrete examples. For example, last year, China Southern Grid International, which is one of the 2 key grid operators in China, have already invested in the wind project called Bashan Jankandi in Uzbekistan with Aqua Power. Another very big state-owned utility called SPIC has co-invested with Aqua Power during the last several years in Red Sea, in Saudi, and also in another 2 PV projects in Saudi. So in the same way, we're working with them outside of China. We're also partnering with them in China markets.
Right. What are if you could give us a background, Yunhe, what the incentives are for these Chinese companies to establish production capacity, say in the Middle East, for example? Is that a commercial decision? Is that something to get around some of these tariffs, for example? Just help us understand what those conversations are with the stakeholders.
I think there are several motivations. I think first, of course, the most important, I think, the G2G angle. Since President Xi visited to Saudi Arabia in 2022, we have seen the huge wave of government-to-government relationship and government-to-government visits. between the two countries, definitely which has been boosting the business activities. The second, of course, is there is already business motivation behind that, because in China it's very competitive, and also the market is getting really saturated. So there are lots of more investors and developers going out of China to basically find new markets.
What types of energy then do you see between the partnerships between China and the Middle East? Are there specific areas where there can be greater cooperation, do you think?
Yeah, I think if you look at the China and Middle East, the overall collaboration, it's the two economies which is really complementing each other. Because, for example, take the example of Saudi, the Kingdom of Saudi Arabia. Under the 2030 vision, that Saudi needs to really promoting industrialization, and there will need lots of manufacturers, contractors, financiers to come to Saudi and invest in Saudi. While China being world's largest manufacturing base or industrial base, and also there's a huge amount of investors who are having very huge interest to going out. This creates a natural complementing, I would say, business advantage between China and Middle East.
Yunhe, final question for you. I think we started out the interview talking about your plans for next year. I wanted to just maybe end on that too. When you look at your plans for next year, you mentioned several provinces or local governments where you're looking to put up that capacity. Could you be more specific, I guess, on in which parts of China are you looking to establish those assets?
Yeah, so we don't have a limitation in terms of geography and provinces in China, but I think we are more focusing on partner. The most important thing is finding the right partner, a reliable partner, long-term strategic partner to invest. So our focus next year will be, we have already shortlisted 3 key student company partners. We are going to work probably one or two of them. Each one of them have, I would say, more than 4 or 5 gigawatt of portfolio across different provinces in the country.
There we go. And we'd love to hear an update further on, and maybe next year let's talk again. Yunhe Liu there, Executive Vice President at ACWA Power, joining us out of our studios in Shanghai. And yeah, by the way, join the top conversations on the energy transition. That was one, hopefully, for you guys at Bloomberg's NEF Summit, where energy, finance, and tech converge. So scan this QR code for more details. And of course, we invite all of you to sign up. That's happening as we speak. Plenty more ahead. This is Bloomberg.
What I would say next up is 7.5. I think that would coincide with some rate differentials. You look at the 2-year rates differential. That point, at this point in time, 7.3. But I would think about that, the exchange rate can overshoot. So 7.5 is the first stop. Can it go higher if you take what happened during 2018? Yes, it can. So I think investors need to prepare for a weaker currency. And in that context, you want to be hedged some of your CNY, CNH exposure.
Yeah, and that was Dominic Schneider, who joined us earlier on the show. He's with UBS Global Wealth Management, head of FX and commodities for the Wealth Management office. So yeah, that was one of the pairs. In fact, I think the only currency that he would actually keep his dollar longs on, dollar China. Apart from that, he's saying fade the dollar strength. In fact, on that note, so 20 years takes you back to 2004. So at 7.5, that effectively takes the exchange rate, if he is correct, takes you all the way back to levels last seen back in 2007. I think it's how we get there is the other thing altogether. It's how disruptive it will be if it's a very quick move to 7.5.
Yeah, that's right. It could be more of a gradual decline. But let's take a look as well at what's happening in the synthetic diamond space.
Yes.
And actually, I'm going to tell you something, Dave.
Please, go.
I sent this story to my significant other, that diamond prices have been cut by 10%.
Okay. Now, did he relent?
He hasn't responded as yet. But
Yeah.
let's see, because diamonds are now 10% cheaper from De Beers, and it is leading to some big gains in synthetic diamond space as well.
Oh, there. Bro, heed the call. Make disinflation your friend. You know what? There are other stocks. I'm not going to talk about this now. Bro, heed the call. Bell's calling. This is Bloomberg.